So welcome to week 6 of the GDCA education program. We hope you had a good time so far, and this will be the final and last time we're doing this. You're obviously always welcome to join future sessions, and you'll have access to the recordings of all future sessions on your platform because that login is yours for life. But this is kind of the official last one for this batch. We will do the same thing as we did last time with a little bit of a recap quiz to review the content from this week. Just want to toss it into the room. Did anybody have any questions at all about the content for this week? Just right up front. No. All right, then we can do a little recap quiz. Gabby, do you want to read out the questions and I'll pop them into the options into the chat?
Yeah, let's get started. Okay, so fun question. Which country has the most forward-thinking crypto regulations? Is it America, the United States, Switzerland, or China? Oh, my money's on China. So it's an interesting question. I'm going to throw it to actually, as people are kind of coming back, I want to just throw it out to, let's start with Natalie Hall. Which of those do you think? Switzerland, US, or China, and why? And if it's not any of those, what would you pick?
So for me, I think Switzerland is definitely the top of that particular list. Absolutely. I think what they have done, certainly in the crypto valley space and creating regulation that is both fit for purpose and clear has really fostered innovation in that country in a way that I don't think anyone would have ever imagined at the beginning of 2019, 2018 when they were starting to think about it. And when we look at Crypto Valley, what we see is that, and certainly not only the businesses in Crypto Valley, but also those in Switzerland itself, is that they are creating, I think it was something like in 2021, they created $600 million, those businesses worth of revenue. They also had 14 unicorns, I believe, and something along the lines, the number of people that they were employing, even in very challenging financial times, had increased by about 50 or 60%. So it just shows, from my perspective, really, that if you have clear regulation that is, easy to understand, that businesses know what they're supposed to be doing, they know the rules and they know what steps they need to take, it genuinely does not only foster innovation, but it also helps to create jobs and create tax profits for the particular jurisdiction as well. And I definitely would also want to pick out Singapore too. That is certainly, it's where we're from, where Merkle Science is from as a company, for sure. We benefited from Massa's accelerator program when we were very baby stage. And really the regulatory system there has, there's been some blips along the way, certainly, that we can talk about. But overall, it's a very clear framework that has fostered innovation as well. So I think oftentimes the concept is that, we operate in the Wild West and there's no good solution to some of these problems. But I think it's jurisdictions like those that are really making it clear that that is not the case.
Yeah, and I think too, just to give some historical background, the World Bank actually worked very heavily with Singapore initially to create a global financial center of excellence. This was maybe like 15, 17 years ago, kind of embarked on the journey of like, what is it exactly that would create that galvanizing focus? And a lot of it came down to legal and regulatory framework, openness to innovation, fintech attraction, and being able to really draw and leverage some of the infrastructure as well as opportunities to have a global audience and investment orientation. So thank you. I'm going to move it over to Anthony. You ready for this? It gets into counterparty, so be excited. How does counterparty risk affect crypto? Is it that uncollateralized crypto loans can default? Or 2, you don't know who you lend to in DeFi? Or 3, CeFi loans to large counterparties can default. So let's throw it in there, give people a few minutes, and then we will chuck it over to Anthony over there to give us his perspective. Oh, you want to be called Tony. Sorry about that. Tony, let's throw it over to you. What do you think? How does counterparty risk affect crypto?
Oh,
Oh, Anthony, can you hear me?
There's
There you
two
go.
Tonys on here.
Oh,
Do you
I'm
mean the other
sorry.
one?
Yeah,
Or you
I'm
mean
sorry.
me?
You.
Oh, me. Okay, sure. So yeah, no, counterparty risk is a real thing. And if I remembered all your choices, I mean, all of the above is true. Sometimes I don't know who I'm lending to. Yes, it's true. CFI can default too. There's no special rules there. That's why I think one of the things that came out from this little, I don't know if you want to call it crisis, it kind of was a crisis recently, was that the DeFi lending platforms maybe held up better than the CFI platforms. And one of the reasons for that is DeFi is built to be trustless. And so therefore it has an over collateralization requirement, and it has auto liquidating features in it. So as the collateral starts to collapse in price versus the loan amount, it'll automatically start liquidating the collateral to get that money back. And so that's unlike what a CFI platform might do, right? CFI platforms can take risks. DeFi platforms just don't have that ability. So in a perfect lender's world, you would rather be riskless than have risk. So yeah, no, the collateral plays a good role. Of course, the cost for that, it's not free. And so there's a huge cost to over collateralization. And that's one of the issues with DeFi. But, from a pure collateral and risk perspective, it's probably better.
Excellent.
Does that answer your question?
Yeah, it does. Thank you. So in effect, it was a trick question. It's all of the above. I wanted to also kind of throw this. This is one that we're going to throw to both of you, but I'll start with Natalie first. What are the biggest opportunities that emerge from a crypto winter? So is it that all bad projects die? Retail investors are flushed out, more money for professionals. Cash-rich crypto companies acquire cheap crypto startups. What do you see as the biggest opportunities that emerge from a crypto winter? So we'll let people kind of answer, but Natalie, what are you thinking? I mean, and it can be none of those options as well. Like you can use it, what you're looking at globally. I have my own thoughts on it, but let's pass it over to you and get your thoughts.
For sure. I think it certainly focuses attention on consumer protection for all of the businesses that, that we work with. I think how to ensure that retail investors, are interacting with the right actors, that they're not getting involved in bad projects. And I do think, the weeding out of bad projects through, whether it's a winter or a correction, however you want to look at it, is a benefit in the sense that getting out the bad actors definitely does good for the entire market as well. But I think we also must think about, in terms of the impact that it has on some retail consumers, it's an incredibly negative thing. So how can we, as a business, as ourselves and working with our clients, but also as an industry, really help to make sure that we are doing the best that we can to protect the consumers that are engaging with us? And I think it really galvanizes those conversations. I think one of the bad things that it does is it does put fuel to the fire in a lot of ways for some of the misconceptions in market about crypto. And certainly in the minds of regulators, that it is incredibly risky. Obviously, market volatility is an incredible concern for them, and it does cause a sort of knee-jerk reaction. So I think the opportunity there is for organizations like Crypto UK, obviously, that I work with as well, and DCA, to work with regulators even harder to try and balance out that narrative a little bit as well. So I think in terms of the biggest opportunity, some of the bad actors die, the bad projects die, I think is a good thing. But I think the bigger one is to look at how do we, better protect consumers in the wake of these kind of events.
Excellent. All right, Tony, let's throw it over to you. What do you think? What is the good that comes out of the crypto winter? What are the opportunities here?
Yeah, I think the single greatest opportunity is that a lot of the projects that are out there that we're taking in funding, we're taking in funding at such a high estimate of value. So those things coming back down to earth are great because now some of the lesser known projects can get funded as well as the really well known ones. All of my venture fund clients. On the one hand, it's bad because some of the companies in the portfolio are now going to have down rounds, which is never helpful. But the new companies that they're looking to purchase are finally priced appropriately or semi-appropriately, and so they're able to get this. That's the single greatest opportunity. But I think there's other ones that have come around. The volatility that hit the market really gave speed to some of the folks in the industry that were developing non-linear products. So like option vaults that are now coming around, right? People who were trying to get option exposure, people who were running long only funds are now coming to light. Hey, you cannot do that. You really do need to hedge. And so, and it's also helped, I think, with the cost of hedging too, as people bring more hedging type products to market, that lowers the cost for everybody. So those are the big opportunities.
Excellent. So I wanted to kind of take a minute. So you've heard from our experts, but now let's let them reveal themselves and their backgrounds. I want to just welcome to the floor Tony Tooth from KPMG. Tony, if you can take a minute just to share a little bit about your firm, yourself, what you do and why you're passionate about digital assets, please.
Sure, thanks. So yeah, I'm a tax partner at KPMG, and I also run the digital asset practice at KPMG. And so our firm covers every part of the digital asset ecosystem, from the project developers to the exchanges to the miners, the big funds that we do, hedge funds, venture cap funds, PE funds, all of the people who are investing into this space, family offices, as well as, the very large exchanges that are out there. So there's probably not a part of the ecosystem we don't touch. We also counsel Fortune 500 companies in their use of digital assets within their own business models. So everybody from InBev to Disney to Uber, you name it, whoever is out there, just your household corporate names, they too are thinking about crypto and other digital assets, NFTs in particular, because they want to interact with their customers, or they want to use the digital payment rails or whatever it is. So yeah, you can bet that we're at work all around the ecosystem.
Excellent. And I also want to welcome to the floor Natalie Hall. Natalie comes to us from Merkle Science. Natalie, can you give us a little bit of an introduction to yourself, your firm, and why you're passionate about digital assets?
Yeah, for sure. So as Gabby said, I work for Merkle Science. We are the crypto risk and intelligence platform. So we work with crypto businesses, with financial institutions, DeFi participants, and government agencies as well, helping really to mitigate crypto risk and to detect crypto crime and enable them to comply with global and local regulations, as I'm losing my voice, which is not very helpful. And so what I am really passionate about, I came to crypto by way of the law and by way of a number of trade associations. And what really interested me about crypto was the regulation around it, and a completely new area of the law doesn't, come along that often. So it was fascinating to me to see how regulators were dealing with it, and then get involved in those processes, both with Crypto UK and also with Merkle, as we work very closely with a lot of the regulators around the world. So I think it's an incredibly exciting space with a huge amount of benefit that it can bring, both to retail customers, but also to enterprise customers as well. So yeah, that's why I got involved.
Well, excellent. So now that we know a little bit more about the two of you, we're going to get into some of our fireside chat, if that's okay. So I'm going to kind of like pitch it out there. Natalie, you spoke last, so I'm going to tag you again. We're going to just kind of get into the regulatory adoption challenges or positive developments that we're seeing at the moment. We've seen a lot of evolution over, I'd say, the past 18 to 24 months. In particular, maybe a first wave look to see to what degree existing legal and regulatory frameworks around the world can meet sort of the evolution or transformation that we're seeing in the digital asset, financial sector, and overarching economy. Can you tell us a little bit about what you're seeing? What are those positive developments? What are the regulatory adoption challenges that you're seeing right now?
I think globally, what we can certainly say is that regulators over the last, as you say, maybe 24, 18 months have really educated themselves to crypto. And it was fascinating to me to start listening to, the Senate hearings that we were listening to as an example, 16, 18 months ago, the level of understanding of crypto was very, very minimal. And now, that has evolved enormously over the past 2 years to a point where certainly as an industry, we feel a lot better understood by regulators. And what we see is so much more consultation with our industry as well, which is really encouraging, which is obviously Gabby spends a lot of her time doing, but there are other trade associations around the world that are really making our voice heard in the crypto regulation process. So I think that is a huge positive change. I certainly wouldn't say that, that has brought fit for purpose regulation in every jurisdiction around the world. We know absolutely that is not true. But I think one of the opportunities that we have now is not only, as you say, Gabby, to look at what regulation is in place that can potentially be adopted for crypto, but also there is an understanding that a lot of it does need to be crypto specific regulation. So we see certainly from the legal bellwethers, people like WEF, people like BIS, who are looking into crypto, that is filtering down into national governments, and then that's filtering down into regulators, where we're starting to get laws that are specifically designed for our industry. And I think that is what our industry needs to grow properly. And without that, we are always going to struggle, and we're never going to get to that optimal state where someone like Switzerland, for example, that have laws that are really set up to help us thrive. So I think for me, making sure that consumers are protected and that investors are safe from harm is certainly always the mandate of governments around the world, but they're starting to see it as a source of innovation and revenue for their particular jurisdiction as well. And just as a micro example of that, if we look at the change in narrative in the UK from a country that was, it was open, it's been open to fintech, and a lot of businesses benefited, certainly in the wake of the 2008 crash. It was reluctant around crypto for sure. It wasn't well understood. And, only 2 months ago, we had our chancellor standing up saying that we wanted England to be the hub for digital asset innovation in Europe. And I mean, that trajectory has happened incredibly quickly, and it is incredibly encouraging. And of course, on your side of the pond, you've got some great advocates for crypto, Crypto Mom obviously being one of them, but there are many, many more within your legislatures. So it's very, very encouraging to see from my perspective.
Yeah, and I think that, you've rightly identified some of the opportunities that different jurisdictions can take to differentiate based on, as opposed to a race to the bottom, which is what a lot of regulators fear, true opportunity to race to the top, and race to the top in recognition of the fact that better regulation is not always more regulation. It is intelligently structured and designed regulation that offers a sophisticated approach to utilizing underlying technology, and also perhaps efficiencies and effectiveness, and ultimately creating advanced consumer protection in some cases. So thank you very much. I'm going to pass it over to our colleague, Tony. I'd love to hear your perspectives, maybe a little bit here at home in the US, as well as sort of a more bend on some of what we're seeing from the tax perspective.
Sure. So, just on general regulatory scheme in the US, right now, I mean, the U.S., as probably everybody on this call knows, the U.S. is behind. We're just behind the rest of the world. So we're playing catch up. So it is great that we do have some people in Congress and in Senate who are focused on this. That's fantastic. Unfortunately, because of where they're starting from, they really have to tackle anti-money laundering, know your customer, anti-terrorism funding, all those kinds of things, and consumer protection, right? They're still back there. So what we want as an industry, we would love some regulations on, hey, is this a security? Is it a commodity? How does this get taxed? How does that get taxed? But we can't get there because they're still bogged down in that other stuff. So that's disappointing, but it's part of the natural evolution, I suppose. So we should just be glad that they're working on it. Now, on the tax side specifically, few things. One, this whole know your customer, anti-money laundering thing, that's playing out in tax too. So in the infrastructure bill that passed last year, we did have new sections 6045 and 6050I, which those provisions are really about reporting, and that reporting is important to the government because then they know who's getting paid what, and they also know that if you're trying to do money laundering or terrorism financing, that's a way for them to track that. So very important. That was passed. They're still trying to implement that. Now, we were supposed to have regulations by now, way before now, because those provisions are supposed to go live January 1, 2023. Obviously, that cannot happen now because we did not get regulations. So that's going to have to be delayed. That's unfortunate. That'll keep Treasury working on that stuff for a while, and it'll divert their attention from other things. So that's where that is. Some other tax things that are happening around the US, though, that I think are helpful. The international division at Treasury is, they are thinking about, they're trying to come up with an answer to allow US-based investment managers to deal in crypto without causing non-US people to get sucked into our tax net. That is something that has become front and center because the UK came out recently saying that they were changing their investment manager rule to allow that for their country. And so we will definitely be on our back foot here. And so they're trying to get up to speed on that. So that would be very helpful when that happens. And then you're probably seeing around the country, a lot of the states are adopting certain legislation in their own states regarding mostly sales tax. And the good thing on the sales tax front is most of them are coming up with a fairly simple rule, which is crypto not subject to sales tax, NFTs are subject to sales tax. I think later, I think we'll need to see some stratification of NFTs, because just saying NFTs doesn't get you very far. That can mean anything. So we'll see better definitions going forward, hopefully. But right now, that's what we're seeing on the tax front.
Awesome. Thank you so much. That was really comprehensive. And I think, for many of us, you have to understand, even if you are not a tax or accounting professional, these are decisions that are influencing a lot of our customers, our own firms, decision-making around whether or not to engage, to mainstream, to adopt, or to participate in the crypto asset market. This is a driving force. If there are, ambiguous or difficult tax rules, people will opt to invest in or participate in other elements of our capital markets or broader financial sector. And so as these pieces of tax policy become more understood, are more, I think, again, precision focused, help to clarify understanding and reduce disincentives to participating in crypto, I think you're going to see a greater degree of adoption and mainstreaming overall. So that's why I think it's very important to always reflect on the tax considerations that we're looking at. You don't have to be the accountant, like, again, I'm a CPA, but still bean counter, to recognize and respect the role that has in financial planning and decision making. I wanted to just take a minute to kind of pivot a little bit, not to a completely different subject, but to one that is very closely aligned with, this concept of legal and regulatory, which is more broadly speaking, compliance. I'm going to throw this to Natalie kind of to kick us off, but how should entities think about implementing compliance processes around digital assets? And I think, your firm has a very strong focus on a lot of these pieces. So maybe even before we talk about how they should think about it, what are you seeing first? And then what would be kind of best practice, or how should they be thinking about it, if that makes sense?
For sure. And I think we used to exist in a world where, compliance was always a secondary concern when people were starting crypto businesses. And this sort of answer can be given in buckets, because there's the crypto businesses that we work with who oftentimes they're either startup or they're scale up, and they don't have a huge amount of resource. So dealing with compliance is both incredibly important and incredibly challenging for them, because they don't always have the infrastructure or the talent in place to do it. And to get those pieces in place are very expensive. And then on the opposite end of the spectrum, we have financial institutions, the larger clients that we work with, who have compliance and regulation, knitted into their very fabric. So they have a very, very different approach, and they're looking for absolute best in class in order to make sure that they're complying with their very much more heavily scrutinized regulatory compliance that they're looking at. And I think always what we advise customers really at any level to think about is really what you're looking for is to do as much as you possibly can to understand and also to comply with the regulations that are imposed upon you, either at a global or an international level. And what we mean when we say that is oftentimes regulators are looking, when they're considering, for example, whether they're going to give you a license, whether they're going to register you, they're looking for the companies that make the best effort. You're not always going to get everything right, but at least you can demonstrate that you've got the right tools and the right processes in place. And really putting protection from consumer harm at the heart of everything you do and everything you implement through your compliance framework is really, really important. So when we talk to our clients, what they're looking for is how best to address some of the main challenges, which Tony has touched on. So whether it's they're looking at their KYC process, they're looking at their AML process, and they're trying to build out those frameworks. And they're really also trying to understand what other, regulations might apply. So we help them specifically with the AML piece of the puzzle. So that's generally what we're talking to them about.
Okay, excellent. Thank you. And Tony, I'm going to throw it over to you for a little bit. Thinking about this, especially around digital asset engagements, digital asset compliance from a tax perspective. Can you share with us a little bit about, your thoughts on this? What are you seeing? Okay, so like generalize it so you don't name and shame, but what are we seeing generally? And then what would you see as sort of the best practice in this space?
Sure, it depends on which segment of the world we're looking at. I think on the retail investor side, I think well, I know if you ask the IRS, they would tell you it is just a blatant shit show. That's what they would say, and it is. Not all their fault though, because one of the problems that we currently have, and this is not a U.S. Only issue; it's around the world. We don't have proper reporting. And I'm not talking about the reporting to the governments. I'm talking about reporting back to your own investor. So if I invest into a DeFi platform, they don't send me a monthly statement and say, oh, here, this is what you got. So I'm kind of left to like keep my own records, which human beings are just horrible at. And so that leads to a place where you get to the end of the year and you're supposed to tax report. They don't have anything. They're not getting a 1099. So, or some other kind of, statement. In the absence of that, you would say, well, you can go to your investment statement. Well, they're not getting that either from some of these places. I mean, if you have a Coinbase account or Kraken or something, you can go on and get it. Some places you can't even do that. So that's a major problem. Reporting is amazing. And that's why, by the way, that's why our government is quite focused on it at the moment. So that's horrible tax compliance. And by the way, I hate to say it, but some human beings are also not completely honest. And so in a self-reporting country like the US, some of that goes to the wayside. And so we have non-compliance. But also, I think once you go to the institutional level, there it's much better, but still not perfect. One, because we don't have real rules, so not everybody is acting uniformly, so that causes issues. We still have a reporting issue, even though they are scraping their own records each day, and so they're keeping a pretty good catalog of trades. But a lot of the software that people are using in that space was designed for TradFi and not for digital assets, and so not everything fits neatly, and we get a little bit of misreporting that goes on there. That's all getting better by the day. People are they're hard at work on that. Some of the people on this call may be actually working in that space. So it's a big industry, so that's getting better. So yeah, the tax compliance reporting, not the greatest. When we leave the United States, it gets I would say minorly better, but they're suffering from a lot of the same ills we are.
Okay, so I wanted to talk, this is the last question for our group discussion, and then we're going to break into groups, and I have a fun conversational topic for us then. But we hear a lot about AML KYC. This is anti-money laundering, know your customer when it comes to crypto. And I wanted to just kind of maybe pick Natalie's brain a little bit, and also I'll throw it back to you too, Tony, just to get a feel from like, where is this controversy stemming from? To what degree is it a challenge? And what are some ways that crypto-oriented firms, and even perhaps those of us who are consumers, can help to stymie some of this?
Definitely. So I think the controversy and some of the misconception comes from the idea that, crypto is completely, there's no way of knowing who's behind it or what they're doing. It's completely anonymous. And actually, the reality of that is a little bit different. And as a company, we work every day to track and trace illicit transactions on the blockchain and make sure that illicit actors are not working with the clients that we ourselves are working with. And so we look at this in two ways. I think when you think about the problem is that in the world of crypto, when any bad actor could create thousands and thousands of addresses on any given day, and they can transact using those addresses, the traditional way of doing it, which is still incredibly important, is taken actually from fiat. And it's taken from fiat transaction monitoring when you're looking for anti-money laundering. And you will have a list of bad actors, so a list of bad actor addresses. And we get those from OFAC sanction lists. We get those from public hacks where people have printed the addresses involved. And also our data and insights team spend a lot of time, going through addresses, tagging them properly. I think we have around 300 million addresses tagged, would you believe, on our system today. And that is a really valid way of doing it. And that is the way a lot of traditional transaction monitoring companies do it. But of course, the challenge and the controversy is, well, if a bad actor can create 1,000 addresses a day, none of those new addresses would be on any blacklist. So they can go ahead and they can sign up for an exchange, they can transact with a peer, and they can do that with malicious intent without anyone being able to know that they're a bad actor or be flagged that they are. And so what our technology, or what the blockchain technology allows us to do, is look at the behavior of addresses. And this is becoming more and more important. We're starting to see regulators look at suspicious behavior. The FATF, for example, are asking for us to be able to identify certain types of behavior that then exchanges or compliance teams within banks or wherever they're doing their transactions are able to understand that they are a potentially illicit actor and that they should look closer at that particular account or that particular wallet or address. And behaviors can be anything. It's a huge range, and they can be customized depending on the risk profile of that particular organization. But it's things like, is it a young address? Has it just been made? That might indicate a higher level of risk. Has it KYC'd? So has it come onto that organization, onto that exchange, saying that they will do $1 million of transactions a year maximum, and actually they're doing 20 million? Or has that particular address done one huge transaction and then nothing else out of that in or out of that address for a period of time? These and many, many other types of behaviors are indicators of potential risk that compliance teams need to be aware of. And so by using that traditional transaction monitoring and the behavior-based transactional monitoring in tandem, what you get is a far, far clearer picture of risk, a far, far clearer picture of potential money laundering actors and that kind of thing. So whilst the perception is certainly that there is no way of knowing what's going on and it's all anonymous and there's no way of properly mitigating risk and protecting consumers, it actually couldn't be further from the truth. And the transparency of the blockchain works in a way far better, as we probably all know on this call, than fiat currency can do. So there is definitely a controversial narrative, but there are lots of solutions to that particular problem. And as we see regulators focus more and more on behavior and to be honest, demand more and more from our clients in terms of what they're reporting on, I think that will start to correct itself over time.
Excellent. And I want to just take another minute or so to throw it over to Tony here. What are you seeing? Like, especially when we talk about it from the perspective of like financial crimes, what are your thoughts when we look at AML KYC compliance, and what would be good practice?
Yeah, so good practice would be for everybody who interacts on blockchain to verify the addresses that they're interacting with. That would be great. I know there's a lot of people who are just absolutely against that. I think it runs counter to the ethos of decentralization, but the truth is, without that, this is just going to exist. And I can tell you, without a shadow of a doubt, money laundering and terrorism financing is happening. It's absolutely happening. And it's just so easy if you think about it. I mean, if I wanted to get funded, I'm in a bad spot on the earth. I'm a terrorist. I want to get funded. There's someone in the United States that wants to fund me, normally not possible through our normal money transmission channels. I can just mint an NFT, put it up on Recur or OpenSea or somewhere, and the person who wants to fund me can buy my worthless NFT for $8 billion. They'll just send me the money, and there's nothing anybody does about that. Now, what should be happening right on those exchanges is all the exchanges, I don't care if it's an NFT or a crypto exchange, they should verify every address that comes onto their platform, right? That's number one. That's just a basic thing. But as we move through this, and I know, again, people hate to be documented, as we like to call it in the TradFi world, but that's what needs to happen. Everybody who gets on an on-ramp or an off-ramp to the blockchain needs to be documented. I hate to say that, but it's true.
And just to add to a little to what Tony has said, regulators are not going to ignore transactions of value of this magnitude. And so for those who say, well, the decentralized world and it should exist without that is a world that's rapidly changing, and we've seen it happen through CeFi over the past 3 or 4 years, and now we're seeing DeFi get on that journey as well. Those transactions will be regulated in one form or another, and I agree with Tony in the sense that there is a responsibility of exchanges or whatever platform they're transacting across to make sure and do everything they can to ensure that bad actors aren't transacting across their technology.
Excellent. Thank you both very much for all of your insights. This has been a really engaging and important dialogue. I wanted to, before we break into our breakout rooms, I'm going to throw it over to Isla Krem, who will do that. But before we get moving, I wanted to pose the question that we're going to focus on. And that is, we've covered a lot of different aspects of this that have dealt with consumer protection, but all of us talk about this need for balance, right, between consumer protection and the need to nurture and develop innovation and growth. So in our breakout groups, I wanted us to kind of have one, introduce yourself to the people you're speaking with if you haven't met them before. I know we're 6 weeks in, but just in case. And then I'll also say, take a minute to think about it. What is the line? How do you define that balance? And how do you strike that balance effectively so that you are growing the ecosystem, okay? But you're also protecting vulnerable populations and people and supporting national security and global positioning. So I'll throw it over to Isla and she'll give us the instructions for breakout. Okay, we'll give everybody a second to kind of come back in. I'll apologize to our group. We got really wrapped up in conversation and weren't able to get through everybody, but I think, I'd like to kind of open it up and get some general feedback. This was a really good conversation. We had a really nice mix from our side. We had, former prosecutors, law enforcement who shared some of their insight on some of the human aspects of, striking this balance, what they thought were some of these very important mitigating measures or actions that corporates, as well as all of us, can take. Because again, you have consumer choice. So sometimes when people say, well, I can't stop anything or I can't do anything, you can vote with your dollars. You can vote to participate or to utilize systems and services that have strong AML KYC systems. And that's one way that you can help to shape an outcome. I wanted to kind of, throw it out there first to get some of the feedback and perspectives from some of our other session leaders. So Natalie, I wanted to kind of pass it over to you regarding this concept of balance. If you could share a bit about what your group talked about and then your thoughts on it.
Yeah, for sure. I think we had a really, really interesting conversation, and, one of the things, or the thing that we talked about, is really education is the silver bullet in terms of protecting consumers. And where is the water's edge in terms of who is responsible for educating consumers as they make purchase choices in the crypto market? We talked a little bit about, from the consumer perspective, oftentimes they have the misconception that the burden of responsibility is fully on the organization that they're transacting with, and perhaps in the same way that it would be in the fiat space. And therefore, they're not aware of their own responsibilities at the point of purchase. And we talked about how regulators are trying to introduce these positive frictions in the client buying process, in the consumer buying process, to ensure that people know what they're getting into as they're making those purchase decisions. But it's really difficult. And what we were talking about is, does that sit with the consumer? There must be consumer choice. You can invest your money where you want to. So there has to be an element of freedom. How much is within the actual vendor themselves, or the exchange, or whatever other platform you're working with? What frictions should they be reasonably expected to put in place? And oftentimes there's a knee-jerk reaction from some regulators where you need blanket bans on all kinds of advertising, and there's probably a middle ground to be found there. And rather than just a ban, what education points can be put into that process? And then finally, where does it sit with the regulators in terms of how much are they doing in order to educate consumers in general about this new way of transacting value, and what they should and shouldn't be looking out for when putting their own money into it? So yeah, it's a very interesting conversation, but those are the things that we talked about.
Excellent. And I'm going to throw it over to Tony now next. Tony, if you could share a little bit from your side.
Yeah, sure. So I think we were universal in our group that requiring some sort of documentation of people in blockchain does not stifle innovation at all. We do agree that it shouldn't be intrusive and it shouldn't be something that has to be done again and again. One thought that we had was that in various jurisdictions around the world, people could be documented with, pick your favorite governmental regulator or independent trustworthy party, and then that documentation is verified and you get an NFT that verifies you are who you are, and then that NFT is your passport around the blockchain and you can transact with other addresses and you can just show them that and they'll know that, hey, that person has been documented. So they don't see my personal identifying information, but they know somebody did and that somebody's trustworthy. So, and we just don't see, like in the TradFi world, even though it's much more intrusive than what I just explained, but yet we do it and no one's like, oh my, I can't start a new company, I can't get funding, I can't, it's just, that's not a real thing. So while it is burdensome, perhaps, and maybe slightly intrusive at times, we just don't see it as problematic.
Thank you. Yeah, and you touch on this question too. Whenever we start to talk about AML KYC, I think a lot of people look at digital identity solutions and are looking at, there may be policy aspects that we can solve around this, but also leveraging some of the unique technology of blockchain to really help to solve this also from a technological standpoint. I really appreciate your deep dive and kind of reflection on the broader concept of digital identity. Okay, I'm gonna go ahead and pass it over to Isla for some of her kind of summaries and perspectives. So Isla, I'll go ahead over to you if you wanted to take the lead.
Yeah, thank you so much. Number one, thanks everyone for sticking with it for the full 6 weeks. And the interesting piece about this specific session is that as we're updating the content every quarter, when we do another round, another batch of this course, this is probably the one piece that will change every single quarter. So it might be worth hopping on the platform and reviewing the updated content and probably also the updated Friday session recording when you get a chance. The next batch actually starts on September 12th. So you should be looking at 6 weeks after that. You'll get another round of regulations in crypto on your platform uploaded. After this, you will also receive a certificate of completion that'll come out sometime, I think, end of today or early tomorrow, and a feedback survey. We would love to hear your thoughts on improvements. Some people have reached out separately to share even more details about content and the platform that you're using itself. We'd love your feedback. You're very much our valued students, but also very awesome guinea pigs so that we can improve as we go along. If you have any questions or need anything aside from that, as you kind of close out your week 6, let us know. We'd love to help you in any way, shape, or form possible. Just some final thoughts on all things regulation. I think this is probably why we're all members of the GDCA, just to make sure that we're understanding exactly how this environment is changing day on day. But I would definitely recommend kind of keeping an eye on the content that the GDCA also puts out on a regular basis on this topic, because it's kind of hot off the press. I think bi-weekly even news things come out from your end. So yeah, thank you so much for joining us, and those are my last thoughts on this week.
Excellent. And you will be receiving as well a survey that we would ask you to complete. As Isla mentioned, this is important to us in terms of continuous improvement and our focus on building curriculum that really reflects the needs of both government and the marketplace. This, as Isla said, concludes our session. We greatly thank you for participating, and we look forward to welcoming you on an ongoing basis in our online community through Telegram. So thank you.